Thanks for showing up. So I'm going to talk about non-GAAP measures. What's the big deal about non-GAAP measures? Chris, I'm not sure that you mentioned, but the Swiss Stock Exchange, the SIX, has just issued some guidance around non-GAAP measures. And this is consistent with what's occurring elsewhere globally. So you've had security regulators, the major ones, IOSCO, ESMA, the SEC in the US, proposing some guidance around non-GAAP measures. So there are clearly concerns around how companies are communicating these measures. It's just worth mentioning, when I'm talking about non-GAAP, I'm referring to the company communicated non-GAAP measures or alternative performance measures. I believe we'll also have some talk around what the data aggregators tend to provide as well. So they do make adjustments to company reported earnings, but that's a different type of pro forma earnings. What I'm talking about is how companies try to convey their performance through alternative performance measures. Beyond the security regulators, you've also had the accounting standard setters, the ISB. They're paying attention to this matter. During the month of March, CFA Institute hosted, or co-hosted rather, an event with the ISB. And the theme of this event was on better communication for investors. And we had various speakers from different, representing different constituencies, investors, CFOs, analysts. And one of the recurrent themes also was this type of measures and how it's a core component of how companies communicate about their performance and what needs to be done to ensure that these measures are reliable and are actually adding value beyond the GAAP or IFRS numbers. Beyond the security regulators, standard setters, we've also had CFA Institute members reaching out to us, members in different countries, US, Netherlands, the UK, Australia, expressing concerns about how companies are communicating on these measures. They tend to be particularly concerned whereby you have companies presenting these measures on an inconsistent basis. So from year to year, they play around with the type of adjustments that they do make in a manner that ends up undermining the ability of investors to do a meaningful trend analysis and in many cases to compare similar companies. And just the overall clarity and transparency around these numbers, how they're reported. So what the security regulators are trying to address is absolutely timely because these measures are relied on heavily by investors when they're looking at companies for fundamental analysis, as Chris alluded to. In my talk today, I propose to cover the components shown on this slide, just giving some broad context as to how we think about non-GAAP measures, where they fit within the evolution of corporate reporting. Some comments around the company communication of non-GAAP measures. I'd also like to share some headline findings based on a survey which we conducted, CFA Institute, we conducted with our members globally. So we got feedback from both buy-side and sell-side investors on how they view these measures, the adjustments that are made, and what they need or expect to occur from the standard setters and from the security regulators to ensure greater reliability in how companies report about these measures. And some brief comments in conclusion about the solutions, what needs to be done. So the SIX has come up with some guidance, but this issue goes beyond just what the security regulators need to do. You've got roles that are important for investors, audit committees, the accounting standard setters, in ensuring that the overall performance reporting framework is robust, whether it includes non-GAAP measures or whether we're looking at GAAP and IFRS numbers. How do we get to a place whereby the level of presentation of information is such that there's no need, or there's less need rather, for non-GAAP measures? So some comments on the broader context. When you think about why do we have non-GAAP measures? I think one viewpoint one could take is that regardless of how robust or how rigorous the accounting requirements would be, because the accounting requirements are general purpose, they're meant to provide standardized information, but in effect, it's an attempt to have a one-size-fits-all reporting framework for all business models. So one could argue that regardless of how robust the accounting framework is, you'll get to a place where you always need some form of alternative performance measures, because there'll be entity-specific factors which are not captured by the accounting requirements. A case in point, I'll just give the example of SAP in how they've, in some cases, provided a non-GAAP revenue measure. They provide this measure because they have fact patterns whereby they have undertaken acquisitions, but the GAAP requirements preclude them from recognizing certain types of revenue. But from their point of view, they believe it's relevant to recognize this revenue. So that's one case whereby they see it's warranted for them to communicate a non-GAAP measure. But also, a very interesting book was recently issued, labeled The End of Accounting. This was issued by an academic. His name is Lev Baruch. And one key finding that he portrayed in this book was that when you look at data from the 1950s right up to 2013, there's evidence of decreasing relevance or less relevance of accounting numbers. So when you look at both the book value of equity and the earnings components, over time, over the years, there's been a declining relevance. And in large part, this could be attributed to the increased intangible asset intensity of many business models. So one could say that the current accounting requirements, the GAAP, IFRS recognition and measurement requirements, in many cases are not up to date or could be too conservative. That's another criticism that's made. So for example, for intangible assets, you do recognize those when you acquire intangible assets, but you don't when they're internally generated. So that's an aspect of conservatism whereby there could be a view that the GAAP portrayal of whether it's assets or ultimately earnings could be rather conservative. Another aspect is also around the complexity of GAAP requirements. And the argument of complexity, I believe, is one that resonates in the Swiss market. I believe Chris, a few years ago, did organize for some discussion around the observed trends of companies switching from IFRS to Swiss GAAP. And one of the justifications tended to be around the complexity of GAAP, or rather of IFRS. And it wasn't necessarily that the specific requirements are demonstrably or inherently irrelevant. So when you think about the fair value remeasurements as one example, it was just a situation whereby investors find a lot of these requirements as being too complex or not really knowing where they fit in, or in some cases, some of the measurements are deemed to be transitory. A good example is for the financial instruments, whereby you have the fair value recognition of on-credit risk. When you look at bank reporting of non-GAAP measures, they tend to strip out this component. And that really feeds into the narrative of GAAP being complex, or investors not really making sense of some of the GAAP requirements. But beyond the shortcomings of GAAP and IFRS, other information is really necessary in a supplemental sense, over and above GAAP. So you can see non-GAAP as fitting within the spectrum of supplemental incremental information required by investors. We're not at a place whereby this other information can supplant GAAP or IFRS, but it needs to be seen as supplemental. Before I go on, it's just what I should have said this at the onset. If you've got any questions at any time, I prefer if the questions are raised as we go along, so that it's just not me talking for a very long time. So if anything comes to your mind, any question, any comment, I would welcome you raising it as I go along. So non-GAAP measures. Here, I've got some examples of what are deemed to be non-GAAP measures. And these are really based on adjusting GAAP or IFRS line items, but also items that are not defined by either GAAP or IFRS. So EBITDA is one example of a line item that's not defined by GAAP or IFRS. It does not include, when we speak about company communicated non-GAAP, we are not referring to other metrics or KPIs. And the examples of other metrics or KPIs that I've laid out in this slide. So GAAP, non-GAAP reporting, why does it exist? You can look at it from a supply-demand perspective. Supply factors, that's why companies communicate these measures. And from an investor standpoint, why is there demand for non-GAAP measures? Companies, why they communicate, academic research has shown that there are two broad reasons. One is to better inform investors. The other is rather opportunistic, or the darker side of non-GAAP reporting. It's about managing the perception of performance. We also find that there's variation on the pervasiveness of reporting of these measures. They tend to be more prevalent in countries such as the US, UK, Australia. There was a study that was done by Deloitte looking at the Swiss stock exchange, and the prevalence is not as high as it is in the US or UK, only 43%. It's worth mentioning this study is rather dated, the Deloitte study. It's data for 2013. And at that time, only 43% of SIX companies were reporting non-GAAP measures. They tend to be prevalent in certain industries, particularly intangible asset intense sectors, the healthcare, technology. And the regulatory environment also dictates whether companies report alternative performance measures. From a demand side, investors need supplemental information as they try and understand earnings components, core earnings. That's a real aspect that investors need to understand. And the current presentation requirements, IFRS or GAAP, are not at the point whereby there's adequate disaggregation of earnings. And for that reason, investors in many cases do need non-GAAP measures. Consensus earnings, that's an institutional practice that also contributes to the popularity of these measures. And I've mentioned GAAP complexity and perceived irrelevance. The next slide has a Swiss illustration that's Novartis, and it just shows the type of adjustments that are made, the popular ones, so amortization of intangible assets, impairments, acquisition-related items. It's interesting. There was a survey that was done by some academics, which was targeted at CFOs. And the CFOs did convey that when they try and manage the perception of performance, acquisition accounting tends to be one area that tends to be commonly one of the tools that's applied to manage the perception of performance. And it's interesting that there's an overlap as well when you look at non-GAAP reporting. Adjustments tend to be largely related to acquisition-based items. So the intangible assets that are acquired, the impairments of intangible assets, acquisition-related costs. For the technology sector, you also find that stock option expenses is a popular adjustment that is made, and one that's very controversial because it's really about managing the perception of performance. And what's interesting in the US, the accounting rules have changed such that it's now favorable to actually recognize stock option expenses. Your profit can be higher than it normally is. And it's interesting to note that some flagship tech companies are now switching from not recognizing stock option expenses and recognizing it when they're reporting the non-GAAP measures. So Facebook, Google, they've all indicated that they'll now recognize stock option expenses. Whereas at a different point in time, they were conveying that this doesn't really conform with their view of what is their core performance. One last point to mention in this slide, you'll notice there's usually an upward bias. The adjustments typically yield a higher adjusted number, or same with the adjusted earnings, adjusted earnings per share. It's normally upward biased.
So I have a question.
Yes.
Not only is it higher, as in the delta between the GAAP EPS or the IFRS EPS and the adjusted number is bigger over time. Do you have data on that? Is that something you see across sectors, across the market?
I haven't done that form of aggregate analysis, and I expect that there'd be variation also, as you've alluded to, by sector. And it's not in every case. This is just the usual trend. It's upward bias, but there are cases where you've actually got downward adjustments. So it's not always that you've got upward adjustments. So I can't make a generalized statement as to whether over time, on a sustained basis, the gap is increasing. There's some data which I'll show in the context of the US S&P 500 firms. When you look at the earnings and adjusted earnings number, the gap has widened in 2014 and 2015. But there are good reasons for that. So, for example, this was really prevalent in the oil and gas sector because of the oil price crash that occurred, and those need to impair the assets of these type of firms. So when you look at that gap, they actually are predominant with oil and gas companies, but not for every other sector. This is a case of Roche. And here, there are some the same recurring items, restructuring, amortization, impairments, but there are others which are more one-off in nature. So debt restructuring, just one example. You can see that only occurred in 2015 and 2014. And pension plan settlements as well. It's a relatively one-off type item in this context. So the Deloitte study, some aggregate data showing impairments were really the most pervasive type of adjustment that were made. And this is S&P 500 companies. Again, restructuring, acquisition, stock option expenses, amortization of intangible assets, impairments. Those tend to be the more common type of adjustments that are made by S&P 500 companies. And it's fairly consistent also when you look at FTSE 100 companies. There's a similar level of frequency for these particular line items. So that's some comments on the typical reporting of non-GAAP measures. Then how do investors use these numbers, and what are the concerns that they have around non-GAAP reporting? The survey that we did, I mentioned, we did find that there's widespread use of non-GAAP measures. You have 65% or thereabouts of our member respondents indicating that they often use non-GAAP measures. Only 4.3% indicated that they never use these measures. For comparison purposes, you'll see that GAAP IFRS reporting, you've got 71%. So slightly higher, but it does show that non-GAAP is a core part of what investors rely on from companies when they're looking at performance, liquidity, or financial condition. We also found that this sophisticated use of these measures, so the various concerns I've alluded to, concerns about the adjustments companies make, some investors are in a place whereby they make or unwind the adjustments that companies have made. So if they deem certain items to be inappropriate, like stock option expenses, they add back those items in their modified non-GAAP measures. So it's an adjusted measure that investors get to. Commonly used non-GAAP measures, in broad terms, you'd say that investors, when they're using these measures, they're really looking at cash proxies, cash earnings proxies, free cash flow proxies, as well as core aspects of performance, core operational performance. And you can see in the demand-based statistics, these tend to be the most popular, the various metrics that are proxies for these different aspects: free cash flow, EBITDA, adjusted EBITDA, tend to be the popular type non-GAAP measures. Reasons for why investors use these measures: to assess earnings quality, period-to-period trend analysis, forecasting of future earnings, because there's the presumption that these are more sustainable because you've stripped out the noisy, transitory aspects such as fair value remeasurements. So they're deemed to be more sustainable. In some cases, disagreement with the GAAP treatment. And this came through particularly in respect of intangible assets and how these are written down over time. So there was a view that some of these write-downs, the amortization of intangible assets, there's a double counting aspect. Because when you take certain types of intangibles, such as customer lists that are acquired, you're still incurring selling expenses on an ongoing basis. And then you're concurrently amortizing the expense related to this acquired intangible assets. So some investors expressed some concern about the double counting component. And some other reasons here, identifying management misreporting incentives. One investor actually said he really likes non-GAAP measures because it gives him a sense of the type of games that management wants to play. It's a peek into the manager's soul, as he puts it. I don't know how effectively they actually enable investors to do that, because it's not in every case whereby there's adequate transparency such that you can see the adjustments in a meaningful way, whereby you can tie up the adjustments that are made to the actual GAAP IFRS number. But nevertheless, with some of the requirements, particularly with the reconciliation, it helps investors understand how management is trying to tell their story. The dark side of non-GAAP measures, to your point, this is the S&P 500 firms. And here you see over time, there was a widening gap. But again, this is largely attributable to the oil and gas firms in 2015. And I would say the upward bias is not necessarily a problem, because sometimes in the media, too much is made out of the non-GAAP being different from the GAAP and it being different in an upward bias sense. But if you understand the construction of the non-GAAP measure, it should not necessarily be problematic. So one needs to be aware of it, that it exists, but I don't think at face value you should always read that a gap between non-GAAP and GAAP is a problematic situation.
Can I have a follow-up on that?
Sure.
It would be great to see how cash flow fits into that chart.
Yes, that's a great point. And there was some analysis done on that. Unfortunately, I don't have it with me, so I really can't comment on that. But the point of the analysis, to your point, was that you need to take a multidimensional view, look at the cash flow as well, look at the non-GAAP, look at the GAAP, and in a sense triangulate and look for inconsistencies. Because that's really part of telling the story, seeing how the different metrics play out over time. These are staple concerns around non-GAAP reporting, and these are the areas that the security regulators, in a sense, are trying to address. So the relative incomparability, because these are discretionary measures where companies decide what to adjust, and even similar companies. So in the pharma sector, you won't have two companies in the pharma sector making the same adjustments. So there's lack of comparability across similar companies, inconsistencies across reporting periods, exclusions that are questionable, particularly when they're recurring. The case of tech companies, stock option expenses, the exclusion of those. Cases where there's a manipulation of these measures, particularly when companies conceal recurring expenses under the label of other. So they could be recurring expenses, but they're neatly packed away in the other label, and investors miss that. One that's not paid much attention to by the regulatory bodies is the application during executive compensation determination. So when you determine how you pay your executives using the non-GAAP measure. And there have been case studies which do show, I remember one particular case study in the US, which showed if you actually use the proper measurement, so over a 6-year period, you would have failed to have paid executives for 3 of the 6 years, whereas on a non-GAAP basis, they were paid through the 6-year period. So this is an area that we've had some investors complaining or raising concerns around this, but there isn't sufficient focus on that. Reconciliation and disclosure of non-GAAP adjustments. The reconciliation is really helpful because it really helps you really understand, sometimes even much more than the non-GAAP measure itself. What is management getting at? And it's just worth noting that the requirements the SIX is proposing, they say you need to make reference to the GAAP IFRS number, but my reading of it is that it's not mandatory to have a reconciliation to the most directly comparable GAAP or IFRS number. And I personally would find that problematic. Other regulators, IOSCO, ESMA, SEC, they all require reconciliation. And the reconciliation is really useful. The examples I gave of Novartis and Roche, those were showing the reconciliation, and you really get a lot of information from both the reconciliation and the disclosures. Lack of assurance on non-GAAP measures. So these measures are not audited. Many investors may not be aware of that. And there's a study.
But they may be right. You may require auditors to opine on your non-GAAP.
Yes. So the current audit standards require auditors to ensure that other information is consistent with what's presented within the GAAP or IFRS numbers. But there's no robust requirements to actually provide assurance of a non-GAAP reporting.
Right.
So it's actually an aspect that's being looked at by the auditing standard setting bodies, both IAASB and other standard setting bodies, because there's been that indication that there's appetite for some form of assurance around non-GAAP measures. And auditors themselves, they have acknowledged that they do not audit these measures. But in broad terms, to your point, because these measures we're really talking about what's outside the financial statements, there is need for auditors to always look at other information outside the main financial statements and ensure consistency with the portrayal of a true and fair view within the financial statements. But that's a very, very low threshold. It doesn't give you any guarantee that the auditors have, for example, when there are questionable exclusions or the accuracy of the exclusions, there's no sense that auditors are actually paying attention to that. Yeah. And whereby there'll be some merits for auditors to potentially also look at these measures would be because auditors, when they're determining the materiality, when they're auditing companies, some auditors actually use adjusted performance measures as well, their own version of adjusted performance measures. So a study that was done by the UK FRC, a thematic review of the enhanced auditor report, they did find that 40 to 60% of the big four audit firms use adjusted performance measures, their own version, to determine materiality. So they should be well placed to have a sense of, are the adjustments that a company making, do those make sense? But it's not clear what form of audit would be helpful. And then this is a great point. The final point is risks associated with greater prominence of non-GAAP measures relative to GAAP IFRS measures, particularly when you look at P ratios or other key metrics, the return on earnings or return on invested capital. So if I'm applying the adjusted measure in the numerator, but I'm applying the GAAP measure in the denominator, that's problematic. That's misleading. And this is just an easy illustration of undue prominence. There was an article that was published on 15th February, which was looking at the top-rated stocks based on the pre-tax margin. And they were using the non-GAAP measure. But the problem with this is whether the non-GAAP adjustments are comparable across all these companies that are being ranked. So this can be potentially misleading for somebody who's just reading it at face value. Most investors would be smart enough to see beyond that, but there are many who are also constrained in having to go further, unwind, and get to their own view of adjusted earnings. So it's important for security regulators to ensure that across the market, there's less likelihood of certain segments of investors being misled due to this form of reporting. This shows PE ratios based on a GAAP, non-GAAP, or modified non-GAAP basis. And the last point of concerns I would mention would be around disclosures. Disclosures failing to adequately explain adjustments. So this is the case of Novartis, which I referred to earlier on. So there are all these adjustments that they do make, and I try to understand, why have you made these adjustments? And there was a very dense footnote at the bottom of the reconciliation. actually, it's amplified what I've portrayed here. So what I've got in these two slides probably was squeezed within the space of the first bullet. You almost needed a magnifying glass to actually make sense of what's being portrayed. And a lot of what's communicated here is fairly boilerplate. It doesn't really tell you why. The economic justification behind the adjustments. Does management disagree with the amortization of intangible assets? For what reasons? What's the nature of those intangible assets that warrant that? So this is one aspect that needs improvement. Clarity. Clarity is very important. It's not just about transparency and giving information. It's important to be clear to investors as well. And interestingly enough, when I look at the SIX guidance that's being proposed, there's really no guidance around disclosures as well. So that's another aspect that potentially would need to be, investors, I think, would need to ask for the need for companies to provide better disclosures around the adjustments, how the calculations are made, and also an explanation of why particular alternative performance measures are appropriate. Do they use them internally for budgeting or other reasons? Just explaining why the use of these measures is warranted. So, in conclusion, I'll just do a wrap-up around what needs to be done, and I alluded to this earlier on. This is what the security regulators are currently doing, coming up with guidance, trying to ensure that there's discipline around the reporting of these measures, and their varied objectives. The SIX has indicated that its objectives are to ensure clear and transparent reporting of these measures. But other regulators go a bit further. Some go as far, ESMA says, it goes as far as ensuring that these measures are not misleading to investors. Expanding the auditor's role, to your point, ascertaining what form of assurance would be helpful. And on the auditors, it's just worth highlighting that Pricewaterhouse did a survey of institutional investors, and they found that only 22% of them consider these measures to be reliable. Hence, auditors have a key role. And in our own survey, we did find that 80% of our members expect some form of assurance around non-GAAP reporting. It could be assurance at the level of the audited numbers, or it could be just about ensuring that the controls and the processes within companies are robust enough when they're generating non-GAAP measures. Audit committees, companies really are the most important stakeholders. They need to understand, or rather, they need to aim at only providing informative and reliable non-GAAP measures. The accounting standard setting bodies need to enhance the performance reporting framework. And the ISB is in the process of doing that. So they're looking at the income statement and the cash flow statement, how these two financial statements need to change, what levels of granularity may help, in a sense, to preempt the need for companies to, or rather the need for investors to rely on these non-GAAP measures. As I said earlier, I suspect that non-GAAP measures will always be needed. Just one example is in the real estate sector, whereby there's in some markets, they're relatively comparable or defined adjusted performance measures for the real estate sector, but you still find adjustments to these adjusted performance measures. So there'll always be situations where companies feel that they need to tell a different version of their story beyond the standardized requirements. Investors yourselves have a key role when you engage with companies, whether it's in a corporate governance context or any other context. If there are aspects of reporting that are misleading or of concern, in the same vein that investors have gotten in touch with CFA Institute and expressed their concerns, I think the engagement with companies should convey or help give a steer towards companies providing meaningful non-GAAP measures. One refrain investors often get is, it's your job to make the adjustments. We've given you our version of the story, and as a good analyst, you get paid to make adjustments. But I think increasingly there's a recognition that analysis has value when it's about generating insight. It's not about fixing or tidying up or normalizing data. And unfortunately, historically, a lot of analysis, the value of analysis or the competitive advantage was extracted when some analysts are able to get a better set of information than others. My view and others' view is that this should diminish over time, and analysts should really compete based on the insights they're able to generate based on a level playing field of the information, a level playing field in information that's provided by companies, rather than where they've got their wherewithal to make adjustments to non-GAAP measures or not. So it's really important the work the security regulators are doing to try and level the playing field and ensure that there's better reporting of non-GAAP measures. I'll stop there, and thanks for listening, and I'd be happy to take any questions.